Hello everyone, and welcome to today's webcast on the interoperability between the IFRS Sustainability Disclosure Standards, or ISSB Standards, and the European Sustainability Reporting Standards, ESRS. My name is Sam Prestidge, and I'm the ISSB Technical Staff Strategy Lead. I'm delighted today to be joined by Sue Lloyd, Vice Chair of the ISSB. It's great to have you here, Sue.
Thanks, Sam. I'm happy to be here, and I'm really looking forward to discussing this important document.
Very good. This session aims to provide an overview of the important work we have undertaken to achieve interoperability, and in particular we will focus on the development of interoperability guidance material, and notably how the guidance illustrates the high degree of alignment between the ISSB standards and ESRS on climate reporting, and also where there are elements that are unique to both sets of standards to provide practical guidance for companies reporting under both the ISSB standards and ESRS. With increasing global focus on sustainability and climate-related disclosures, it's crucial for organisations to navigate these standards effectively. Therefore, the ISSB, the European Commission and EFRAG have collaborated to achieve a high degree of alignment, especially as mentioned in climate-related reporting. This joint effort ensures that companies can comply with both sets of standards efficiently, enhancing the comparability and reliability of sustainability disclosures globally. So I'll start by setting the stage for understanding the broader context of this work and what we may mean when we say interoperability. As disclosures about sustainability risks and opportunities become mandatory across the globe, the practice is becoming an integral part of corporate transparency and accountability. Investors are increasingly demanding robust sustainability-related information to make informed decisions. The International Sustainability Standards Board, established by the IFRS Foundation, aims to deliver a global baseline of sustainability-related disclosures that meet investors' needs for comparable decision-useful information. The European Sustainability Reporting Standards, developed by EFRAG and the European Commission, have a complementary yet broader focus on providing decision-useful information to investors and also relevant information to a broader range of stakeholders, and that's in relation to European Union public policy goals. The ISSB published its inaugural standards, IFRS S1 and IFRS S2, in June 2023, and the European Commission finalised ESRS in July 2023. Many companies will be required or will choose to disclose information about sustainability-related matters using both the ISSB standards and ESRS. Therefore, it is important that the two sets of standards work well together, or in other words, that they are indeed interoperable. Alignment and interoperability helps to reduce duplication in reporting, complexity and fragmentation to help provide decision-useful sustainability-related information for investors. Now, this webcast will outline how these standards are designed and work together, ensuring that organisations can meet both sets of standards and requirements effectively. In this webcast, we will go over the interoperability guidance specifically to provide an overview of the opening section, section 1, of the document, which covers some of the key concepts and how both sets of standards refer to each other. We'll also consider the common disclosures and the basis for alignment between some key aspects between the two sets of standards. We'll move on to cover elements in the standards that companies will need to approach in a specific way to comply with both sets of standards, and then also we'll look at the incremental disclosure requirements in ESRS. So with that, Sue, perhaps you can move on to give us an outline of how we worked with the European Commission and EFRAG to develop this guidance document.
Sure, thanks, Sam. So when we were developing IFRS S1 and IFRS S2, our stakeholders told us pretty consistently that we needed to think carefully about the interoperability by engaging with jurisdictions who were developing requirements in parallel to the ISSB that were likely to be significant reporting requirements for global entities to rationalise how the ISSB's inaugural standards would relate to those other standards and frameworks. And what people really wanted us to do was to avoid having disconnected but similar reporting exercises for them to contend with. And it's important to note that we, of course, are interested in many jurisdictions. So we're talking about Europe today, but when we're doing sustainability reporting, we're thinking more broadly. So we've established groups such as our jurisdictional working group, where we work with jurisdictions to develop our global baseline together with them to facilitate use of our standards around the world, but also to consider cases of interoperability with other standards. But Europe was a bit of a special case because ESRS were being developed in parallel to the ISSB standards. In fact, even before we were born, they were working on it. So the ISSB engaged bilaterally with the Commission and EFRAG to try to help the ecosystem. So our engagement focused on finding disclosure requirements that could be aligned and opportunities to align definitions, and where disclosure requirements were unique to either set of standards, to identify those and to work on aligning some key concepts. And as a result of that work, when we were drafting our respective sets of standards, the ISSB, the Commission and EFRAG achieved a high degree of alignment between the ISSB standards and ESRS in the climate-related disclosures where we both have specific disclosure requirements. Our focus then shifted to developing materials that could explain to people how this alignment worked. And in May 2024, the Foundation and EFRAG published this guidance material. The guidance is freely available to access on our website. It doesn't change what's in the standards, and despite its thoroughness, I'm afraid companies still need to read the standards in order to be sure to comply with them. But it's a great way to get started and to know what to look at and navigate when you apply both sets of standards together. So that's how we work together. So let's get on to what's covered in this interoperability guidance material. So the interoperability guidance document is structured to help companies to understand how to align their reporting processes to comply both with the ISSB and ESRS requirements. And the goal of our guidance is to increase the efficiency for companies that report using both sets of standards. But there's sort of a few health warnings or things to note when you're using this interoperability guidance, like all good documents coming from the Foundation. So it has to be read in conjunction with the relevant standards. Companies can't just rely on the guidance alone to ensure that they're compliant with ESRS or the ISSB standards. And this is really important. The guidance is a really helpful starting point, but I'm afraid you need to refer to the standards as well. The document is focused primarily on climate, and that's where the area where we've both got specific disclosure requirements in place. So it includes all of the disclosures in our climate standard S2 and all of the climate disclosures for ESRS. It covers things that are mandatory rather than things that companies may disclose, and the document doesn't cover the particular transition requirements in full. We touch on them a little bit, but where they're relevant, we set out some related requirements, but we don't do it comprehensively. And the last thing to note is it's dated as of May 2024, so it's based on the standards and requirements in place at that time. It's probably also worth noting that nothing in the guidance can change what's required in either sets of standards. So you can't look at this and use it to override any of the requirements in the standards. The guidance is educational in nature. So with all of that, Sam, could you take us through the structure of the guidance and what's covered in each of the sections of the document?
Absolutely, Sue. Happy to. Section 1 relates to the general reporting requirements in ESRS and ISSB standards and explains how the two sets of standards are interoperable with regards to materiality, presentation, disclosure for sustainability topics including climate, and topics other than climate, as well as the reliefs included in the standards. Section 2 focuses on climate-related disclosures and those that are common, and illustrates the high level of interoperability achieved between the two sets of standards in relation to climate. Moving on to Section 3, which explains what a company starting with ESRS needs to know when also applying the ISSB standards to enable compliance with both sets of standards. Section 4.1 explains what companies starting with the ISSB standards needs to know when also applying ESRS to enable compliance with both sets of standards. And finally, Section 4.2 really covers two things: climate-related disclosures in ESRS that do not have an equivalent requirement in the ISSB standards, and secondly, for disclosures that do have a common component set out in Section 3, particular additional disclosures required by ESRS that are incremental to the common disclosures that were identified. Now, we can get into some of the detail, starting with Section 1 and the comments on general requirements in the ESRS and the ISSB standards, and we will start with materiality. Materiality is, of course, a foundational concept for both the ISSB standards and ESRS. Under the ISSB standards, IFRS S1 and IFRS S2, information is material if omitting, misstating, or obscuring it could be reasonably expected to influence investor decisions. ESRS, on the other hand, requires an entity to consider both financial and impact materiality. A company reporting under ESRS or ISSB standards that also want to meet the disclosure requirements of ISSB standards or ESRS will therefore need to consider the relevant materiality requirements of ISSB standards or ESRS respectively. However, the definition of information that is considered material for users of general purpose financial reports is really importantly aligned between the two sets of standards. Section 1 of the guidance material provides further information in relation to the alignment of the financial materiality in both sets of standards. Now, looking at this in practice, this alignment means that in assessing whether a particular disclosure is considered material in applying the ISSB standards, that assessment is aligned with the assessment of whether that disclosure is financially material in accordance with the ESRS and conversely. This is important because in relation to financial materiality and providing investors with decision useful information, the two assessments are expected to provide an aligned outcome. The practical consequence of this is that, for example, when a disclosure is set out in both sets of standards, as set out in Section 2 of the document, a company would need to provide that disclosure when using ISSB standards if it is assessed to be financially material, whereas a company would need to provide that disclosure when using ESRS if it is either financially material or impact material. Information about the respective presentation requirements in both sets of standards can also be found in Section 1 of the document. ESRS is more specific than ISSB standards when it comes to presentation in that ESRS mandates that sustainability-related information be included in a dedicated section of the management report, known as the Sustainability Statement. In contrast, the ISSB standards allow these disclosures to be located anywhere as long as they are presented in the general purpose financial reports. To comply with ISSB standards, companies must specifically consider paragraph 62 of IFRS S1, which says that sustainability-related information that is financially material cannot be obscured with additional information. We are closely engaging with relevant stakeholders as practice further develops to ensure the global baseline is indeed identifiable. We are continuing to work closely with EFRAG in relation to our respective digital reporting requirements as well, which will really be a key element in this area, as digital taxonomies could be used as a way to identify the ISSB's global baseline within a broader set of information. Now, looking at the references to both sets of standards. Each set of standards refer to the other to the benefit of interoperability. ESRS refers to the IFRS industry-based guidance. This importantly includes both the industry-based guidance on implementing IFRS S2 and the ISSB standards. This enables companies to use that guidance to complement its disclosures prepared applying ESRS to cover sustainability matters that are material for the undertaking in its sector or its sectors. Because of this, a company using ISSB standards that wants or needs to comply with ESRS will be able to leverage its disclosures prepared following the ISSB standards and IFRS S2 industry-specific disclosures. Now, also, importantly, IFRS S1 makes reference to ESRS as a source of guidance. IFRS S1 sets out the sources that can be used to identify the sustainability-related matters to report on and the sources that can be used to identify suitable disclosures for topics beyond climate. In identifying appropriate disclosures about an entity's sustainability-related risks and opportunities, IFRS S1 states that an entity may refer to and consider the applicability of ESRS as a source of guidance. You can't just substitute your ESRS reporting for ISSB reporting, but indeed you can leverage ESRS disclosures to meet the requirements of IFRS S1, as long as those disclosures enable the entity to meet the objective of IFRS S1 in meeting investor information needs and do not conflict with ISSB standards. A company needs to exercise appropriate judgment when identifying sustainability-related risks and opportunities and associated disclosures to ensure they provide users of that information in faithfully representing the sustainability-related risk or opportunity. In this context, paragraph 57 of IFRS S1 states that in the absence of an ISSB standard that specifically applies to a sustainability matter and to the related risks or opportunities, an entity shall apply judgment to identify and prepare the information to be reported. Therefore, companies can leverage ESRS disclosures in their ISSB disclosures, helping companies adopt a comprehensive and cohesive approach to sustainability reporting, enhancing transparency and comparability across different jurisdictions and regulatory environments. And importantly, this really reduces the risk of duplicative effort. Now finally, in section 1, we do cover reliefs as well. Both sets of standards include reliefs to assist companies in their compliance. These reliefs can vary, but generally aim to provide practical leeway in reporting, especially during the initial adoption phase. Now, companies reporting under both frameworks need to be careful to navigate these reliefs as they are not identical and in order to ensure compliance. Now, let's explore the alignment between the ISSB standards and ESRS, and that's illustrated in section 2 of the guidance. Sue, will you be able to take us through some examples of alignment, please?
Sure. So as we've already mentioned, there's a high degree of alignment in the climate-related disclosures in the two sets of standards, and that's set out in this section. The interoperability guidance material maps the climate-related disclosure alignment for the benefit of stakeholders. And the analysis uses the requirements in IFRS S2 essentially as an anchor, and then sets out the corresponding requirements that were identified in ESRS. So let's use the disclosures in relation to a company's governance in relation to its management of climate-related risks and opportunities as an example of where there has been identified a high degree of alignment in our literature. So for instance, the ISSB's S2 standard, paragraph 6, corresponds to several ESRS requirements, including ESRS 2, paragraph 22A, and ESRS 2, paragraph 26B. Both sets of standards require companies to disclose information about the governance processes, controls, and procedures that are used to monitor and manage sustainability-related risks and opportunities, in this case climate ones, and the guidance illustrates this. Next, let's move on to a more specific area of alignment. Let's consider the specific requirement about the current and anticipated financial effects. So both ISSB standards and ESRS require disclosures on the current and anticipated financial effects of sustainability-related risks and opportunities, including climate. This involves outlining how these risks and opportunities impact the financial statements. And the alignment here really helps companies to streamline their reporting processes, ensuring that it's possible to provide the same information to meet the requirements in both sets of standards. So this requirement for companies to disclose their current and anticipated financial effects is an important aspect of alignment, as it interacts with the financial statements and it allows companies to explain to investors the relationships and connections between the sustainability-related disclosures and information in the financial statements. There's one specific aspect to consider in relation to current and anticipated financial effects and how the respective standards allow for a range of quantitative information to be provided, and that's covered in section 4.1 of this guidance. To hear more about the disclosure requirements, little ad break here, the requirements on current and anticipated financial effects in the ISSB standards, we've actually produced another webcast on this topic, which you can find on our website. Now finally, there are some instances in section 2 of the guidance where we supplement the aligned paragraph references in both sets of standards with some further information, so from further explanations to provide some further context or explanation for the basis for the alignment that we identified. So we basically set out here what a company needs to know in order to ensure that their disclosures can really meet both sets of standards. An example of this can be found in relation to the methodology and validation for setting climate-related targets. While the disclosure requirements are aligned overall, IFRS S2 specifically requires disclosure of whether the target and the methodology for setting the target have been validated by a third party, whereas ESRS E1 requires disclosure of whether the targets have been externally assured. And the guidance notes that entities applying ISSB and ESRS should ensure disclosure is provided so that both of those requirements can be met.
Thank you very much, Sue. So now we can explore an example of an area where companies will need to be aware of specific requirements when starting with the ISSB standards, or vice versa when starting with ESRS. And that's explored in sections 3 and sections 4.1 of the material. Sue, perhaps we can consider the example of carbon credits.
Sure. So this is a good example of where both sets of standards require information about a similar thing. So both require information to be provided about carbon credits. But there are some very specific requirements which differ in a number of respects. And the guidance, I hope, helpfully provides information about these differences. So let's look at carbon credits. ESRS E1 requires detailed disclosures on carbon credits, and paragraph 36E of IFRS S2 requires a company to disclose the planned use of carbon credits to offset greenhouse gas emissions to achieve any net greenhouse gas emissions targets that a company has put in place. Now, ESRS E1 specifically requires a company to disclose the total amount of carbon credits that have been cancelled in the reporting period, and the total amount of carbon credits to be cancelled in the future, and whether they are based on existing contractual agreements or not, a very specific set of requirements. Paragraph 34B of ESRS E1 does not allow an entity to use carbon credits to claim the achievement of greenhouse gas emission targets. So there's very particular terminology points made in E1 in this space. ESRS E1 also defines carbon credits in a very particular way, as only relating to the reductions or removals outside the entity's value chain. That's in paragraph 56B of ESRS E1. And there's separate disclosure requirements for the removal of greenhouse gas and storage projects inside the value chain. IFRS S2 doesn't make this distinction between carbon credits arising within or outside the value chain. So importantly, the interoperability guidance considers the practical points to consider for companies really to comply with both of these sets of standards, which have very particular nuances in these sorts of cases. For those applying ESRS E1 that also want to comply with IFRS S2, the company needs to ensure its disclosures about the characteristics of carbon credits meet the requirements in IFRS S2. So, for example, all planned use of carbon credits needs to be disclosed, and all carbon credits as defined by IFRS S2 need to be covered. Could be a little bit broader than what's covered by ESRS. For those applying IFRS S2 that also want to comply with ESRS E1, the company needs to be aware that non-verified or carbon credits verified under schemes not recognised as quality standards, or carbon credits that arise from within the value chain, can't be disclosed as carbon credits applying ESRS, and therefore they need to be excluded from disclosures about carbon credits applying ESRS. So because IFRS S2 may require disclosure about carbon credits used by an entity that are excluded from ESRS reporting, a company might need to disaggregate the information that it provides about carbon credits to really be sure they meet the very particular requirements of ESRS and IFRS S2. We've covered an example where companies need to consider specific approaches to comply with both sets of standards, and now we've mentioned earlier there are also matters covered by the interoperability guidance material that are unique to the ISSB standards. So Sam, maybe you could take us through that example.
Certainly, Sue. So let's look at an example of where there are specific requirements in the ISSB standards that a company will need to consider beyond those in ESRS. Now, a useful example for this is in relation to financed emissions. Now, both sets of standards require the disclosure of the amount of financed emissions, because both require disclosure of the amount of Category 15 Scope 3 greenhouse gas emissions when material. However, IFRS S2 has specific additional disclosure requirements regarding Scope 3 Category 15 greenhouse gas emissions that apply to companies with asset management, commercial banking, or insurance activities. Until ESRS sector-specific standards are in place, if Scope 3 Category 15 greenhouse gas emissions are material, a company is expected to use the transition provision in ESRS 1 to identify relevant sector-specific disclosures in relation to those emissions using available guidance, including IFRS S2. Therefore, an entity applying ESRS E1 that has asset management, commercial banking, or insurance activities, and that also wants to comply with IFRS S2, should provide information in accordance with the specific requirements relating to those in IFRS S2. Before wrapping up, we will briefly cover section 4.2 of the guidance. Now, this is the section that outlines the additional disclosure requirements that are required in ESRS beyond those in the ISSB standards. Now, this is an important section for companies using ISSB standards that need to comply with ESRS, as this information needs to be provided in addition to what the ISSB standards do require. This section contains two tables, one which lists the incremental disclosure requirements in ESRS 2, and the second lists the incremental disclosure requirements in ESRS E1. ESRS contains these additional disclosure requirements as a result of the standard's complementary yet broader remit than the ISSB standards that we spoke to earlier. Now, these requirements are, in the most part, related to providing information to a broader range of stakeholders beyond investors, and may specifically relate to European Union law and regulation. Now that we have provided an overview of the document, we recommend that our stakeholders fully engage with its contents and, of course, to further understand the high degree of alignment achieved here. The information itself is freely available on the IFRS Foundation website, so please do have a look at it. The interoperability between the ISSB Standards and ESRS offers a streamlined approach for companies to comply with global sustainability reporting requirements. The high degree of alignment, especially in climate-related disclosures, simplifies reporting processes, while the clear understanding of how a company can make specific decisions in order to comply with both sets of standards in an efficient manner. We would like to thank our colleagues at the European Commission and EFRAG in relation to this joint work. As the ISSB's work continues, including through the establishment of its 2-year work plan, we are continuing to work closely with our colleagues in Europe to ensure interoperability is a key consideration for our work moving forward. We'd like to thank you very much for joining us today, and we hope this session has provided valuable insights into the ISSB Standards and ESRS interoperability and how companies can use the interoperability guidance document to ensure compliance with both sets of standards. Thank you very much.
Thank you, Sam, and thank you, listeners.